Ever wondered how the tug-of-war between the Federal Reserve and the Treasury impacts the economy? A fascinating question, isn't it? To understand this, let's start by introducing the two main players on this economic battlefield: the Federal Reserve and the Treasury. The Federal Reserve, often referred to as the Fed, is the central banking system of the United States. It's the monetary policy sheriff in town, with the power to influence interest rates and the amount of money circulating in the economy. The Fed's decisions can make or break the financial conditions in the country and, by extension, the world. On the other side of the battlefield, we have the U.S. Department of the Treasury. This government agency is responsible for promoting economic prosperity and ensuring the financial security of the United States. The Treasury's duties range from producing all U.S. currency to managing federal finances and advising on domestic and international financial, monetary, economic, trade and tax policy. The economic landscape is currently witnessing an intriguing power play between two individuals: Janet Yellen, the Treasury Secretary, and Jerome Powell, the Fed Chair. The tension arises from their differing views on how to steer the economy, particularly through two contrasting strategies: quantitative tightening, or QT, and quantitative easing, or QE. Yellen, representing the Treasury, is pushing for QE, a strategy that involves the Fed buying securities from the market to increase the money supply and stimulate the economy. On the other hand, Powell, at the helm of the Fed, has been implementing QT, which is essentially the opposite of QE. It involves the Fed selling securities to reduce the money supply and prevent inflation. The decisions made in this economic tug-of-war could have far-reaching implications. If Powell keeps interest rates high and continues with QT, we could be looking at a potential global banking collapse. If Yellen gets her way with QE, we could see a significant increase in the monetary base, essentially creating money out of thin air. So who will emerge victorious on this economic battlefield? Only time will tell. Let's dive into the world of economics and the power play between these two forces. Scene script. Have you ever heard of QT and QE and wondered what they mean? Well, let's delve right into it. QT, or quantitative tightening, is the Federal Reserve's method of reducing the money supply in the economy. It's like a financial diet, trimming the fat from the economy by selling off securities, mainly government bonds, and consequently reducing the amount of cash floating around. By doing so, the Fed aims to control inflation and stabilize the economy. However, just like a diet, QT can be a tough pill to swallow. If the Fed tightens too much, too fast, it could choke off economic growth and lead to a recession. This is where our first economic gladiator, Jerome Powell, steps into the ring, wielding the sword of high interest rates to keep the economy in check. On the other side of the arena, we have QE, or quantitative easing. This is the Treasury's tactic of choice, championed by our second gladiator, Janet Yellen. QE is like a financial feast. The Treasury buys up securities, pumping more money into the economy, stimulating growth and encouraging investment. It's a tempting strategy when the economy is sluggish, but it's not without its risks. Quantitative easing can lead to a rapid increase in the monetary base, essentially printing money out of thin air. This can cause inflation to skyrocket if not carefully managed, and this is where the clash begins. Janet wants a feast of QE to kickstart the economy, while Jerome insists on a diet of QT to keep inflation in check. So QT and QE, two opposite strategies, two economic gladiators. One wants to tighten the belt, reducing the money supply and increasing interest rates. The other wants to loosen the purse strings, increasing the money supply and lowering interest rates. Each strategy has its advantages and disadvantages, its risks and rewards. These are the weapons of choice in this economic battle, but what happens when they clash? Stay tuned to follow the showdown between these economic gladiators. Their decisions will shape the future of our economy. What if the Treasury Secretary wants to shift gears and push for QE? Well, that's exactly what Janet Yellen is doing. As the Treasury Secretary, Yellen has a significant say in the direction of the U.S. economy. And her current direction? She's advocating for quantitative easing, or QE for short. So what is QE? In simple terms, it's an economic policy where a central bank like the Federal Reserve creates new money to buy government bonds or other financial assets. This can drastically increase the monetary base. Think of it as printing more money, but in a digital age. Now, why would Yellen push for QE? There are a few reasons. For one, QE can stimulate economic growth by making it cheaper for businesses and consumers to borrow money. This can boost spending, investment, and in turn, economic activity. Another reason is inflation. In a low-inflation environment, QE can help drive prices up to a more desirable level. It's a delicate balancing act, but when done right, it can keep the economy humming along. But, and there's always a but, QE has its downsides too. The increase in the money supply can lead to inflation overshooting its target. And if not managed properly, it could create asset bubbles where the prices of assets like real estate or stocks are driven up to unsustainable levels. So, Yellen's push for QE is not without risks. But she believes that the potential benefits outweigh the risks, that the boost to economic activity and the controlled increase in inflation are worth the potential pitfalls. And what about the Fed? While the Fed is independent and makes its decisions based on its mandate, it can't ignore the Treasury Secretary's stance, especially when that Treasury Secretary is Janet Yellen, a former Fed chair herself. Yellen's move could be a game changer. But what about the Fed? What if the Fed chair decides to keep interest rates high despite the Treasury's push for QE? Let's delve into this scenario. Jerome Powell, the Fed chair, sits at the helm of the Federal Reserve, the central banking system of the United States. It's his responsibility to maintain the monetary and financial stability of the country. In our hypothetical scenario, Powell decides to counterattack Janet Yellen's move by keeping the interest rates high. But why would he do that? Powell might argue that high interest rates are necessary to maintain a stable economy. By keeping the rates high, the Fed can control inflation, stabilize the economy, and encourage savings and investments. This move might also be seen as an attempt to maintain the independence of the Federal Reserve, an institution that traditionally operates separate from the political winds of the day. However, this counterattack is not without its risks. High interest rates can lead to higher borrowing costs, making it more expensive for businesses and individuals to take out loans. This could potentially slow down economic growth and lead to a recession. Moreover, if Powell keeps the interest rates high despite the Treasury's push for QE, it could lead to a global banking collapse. Here's why. In an environment of high interest rates, the cost of borrowing increases not just domestically but globally. This could lead to a credit crunch where banks are less willing to lend, leading to a slowdown in the global economy. And if the situation worsens, it could potentially trigger a global banking crisis. So Powell's counterattack is a high-stakes game. It's a balance between maintaining economic stability and risking a global economic downturn. It's a dance between the need for independence and the reality of political pressure. It's a tug-of-war between the Treasury's desire for quantitative easing and the Fed's inclination towards high interest rates. So, who will win this epic battle? The Treasury or the Fed? As we move into the final showdown, the answer to this question becomes crucial. The stage is set, the battle lines are drawn. Who will emerge victorious in this economic showdown? This is the big question, the one that has us all on the edge of our seats. This isn't just a tussle between two economic powerhouses, it's a battle that will shape the future of our economy. The struggle between the Federal Reserve and the Treasury is more than just a contest of wills. It's a fight for control over the nation's financial future. On one side of this economic tug-of-war, we have Janet Yellen, pushing for quantitative easing. She's advocating for the expansion of the monetary base through the printing of money, a move that could stimulate the economy and potentially ease financial tensions. Her strategy is daring, bold, and not without its risks. On the other side, we have Jerome Powell holding the reins of the Federal Reserve, steadfast in his commitment to quantitative tightening. He's advocating for higher interest rates, a move that could stabilize the economy, but also has the potential to tip the scales towards a global banking collapse. It's a high-stakes game, and he's playing it with the steely resolve of a seasoned economist. Both strategies have their merits, their pitfalls, and their fiercely loyal supporters. But the question remains, who will have the final say? Will Jerome's commitment to quantitative tightening prevail, or will Janet's push for quantitative easing carry the day? The answer to that question could have far-reaching implications for the economy and for us all. As we watch this economic drama unfold, it's critical to remember that the outcome will not only determine the future of these two economic powerhouses, but also the financial future of our nation. It's a battle that's being fought not just in the boardrooms and on trading floors, but in every home and business across the country. In the end, the economy's fate hangs in the balance. Stay tuned as we continue to explore this compelling economic saga.